But way off in the future, you could say, okay, if we're on a Bitcoin standard, it doesn't matter. There are no dollars. You're not thinking of it in terms of dollars. You're thinking of it as, okay, zero point 0.01 Bitcoin will buy me that car, or zero point 0.1 Bitcoin will buy me that house. That you're thinking in dollar terms instead. And this is the hard part for people to get out of, because we've been conditioned so deeply to think of everything in dollars or euros or whatever.
To kick things off, let's take a closer look at the deficit. Right now, the U.S. is spending at unprecedented levels, over $2 trillion annually, despite the economy not being in a recession. Lavish calls this madness. And he's right. When there's no economic crisis, large deficits can create a dangerous scenario. Normally, we'd expect government spending to ease off when the economy is stable, but here we see the opposite, with massive funds being channeled into various projects. This excessive spending doesn't necessarily add long-term productivity, creating a system where inflation can take hold. Lavish explains that this government spending, while useful for certain short-term goals, creates inflationary pressures. Inflation occurs not just because of demand, but also because the government is putting more money into circulation without increasing real value, which disrupts economic balance. And this is exactly the challenge the Federal Reserve is facing.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We're running $2 trillion plus deficits at a time that we're not even in a recession. Like, this is just so mad. Like, this is absolute madness that we're spending this much money in a time that we're not even in a recession. What's it doing? Well, it's fighting the Fed, right? So the Fed is raising rates, yet at the same time, you have an inflationary pressure here from the government spending so much money, and running those deficits is inflationary. And so, but that's going into projects that are not as productive, but they're creating inflation in certain areas, especially asset inflation. But so that's kind of where we're at with the Fed trying to fight it with interest rates. So the second thing they can do is go to, you have the two mandates, maximum employment and stable pricing, but then they have two tools. So it's the interest rate tool, and like you said, they've got their monetary management. So they can either provide liquidity into the system, or they can take it out. And they do that by either quantitative easing, where they actually go into the market using the primary banks to go into the market and to the dealers to go buy treasuries and put them on the Fed's book. And so they print money to do that. So that's more money going into the system. And the second thing they can do is they can take that back. So during COVID, you saw that we printed almost $6 trillion in the matter of a year and a half, going out there buying treasuries and mortgage-backed securities. Thank you so much. So that's also helped the mortgage market and keep pricing housing prices high. But so they were earlier this year and last year, they were selling those treasuries off the books, which would be taking money out of the system. But then they kind of slowed it down. So this past spring, they went from $60 billion of sales and maturity roll off. They just let them mature. They don't replace them. $60 billion a month. They took it down to $25 billion a month. That's nothing. So they're essentially not really doing QT anymore. And so what has happened is you've seen inflation kind of stop. It's come down from 9%. It's kind of stopped about 2.5%, 3%. And it's holding steady there. And that's why, because you've got those two forces kind of playing against each other now.
With this background, Lavish discusses the unique role Bitcoin could play as a reserve asset. Bitcoin's key advantage is its scarcity. There will only ever be 21 million Bitcoin. Unlike traditional currency, which governments can print endlessly, Bitcoin's supply is finite, making it an ideal asset to maintain value over time. Lavish compares this concept to the gold standard before the US left it in 1971. Under a Bitcoin standard, inflation could potentially be curbed because Bitcoin's supply can't be manipulated to cover deficits or inflate away debt. The shift to Bitcoin would allow us to benefit from natural deflation brought on by technological advancements. As technology improves, production costs drop, and with a fixed monetary standard like Bitcoin, prices could gradually decrease. Lavish even suggests that artificial general intelligence, AGI, expected in the coming decade, could significantly enhance productivity. AGI could lower production costs further and create wealth with fewer resources. Under a Bitcoin standard, society could benefit from this deflationary effect rather than trying to sustain inflation artificially.
Well, long-term solution, because it's an asset that can't be printed. It's got a finite supply, and so in the year, as you know, 2140, the last fraction of Bitcoin will be mined, minted, created. And so we know how many is going to be 21 million Bitcoin. That's the finite number. It's completely decentralized globally, and it's immutable. And so the reason that it would be a great reserve asset, and I think it's going to take time for central banks to come around to this. This is not going to happen next year. Trump talks about adding it to the balance sheet as a reserve asset. Maybe it will happen, maybe it won't. It will take legislation, a lot of fighting. It could take all 4 years if he's elected. But more likely is that down the road, there will be central banks, smaller central banks like El Salvador, doing what they're doing and adding it to their balance sheets. And so why is that good? It's because it can't be expanded. It would be like going back to the gold standard before Nixon took us off that. And if you go look at those charts and on inflation, expansion of the money supply, they skyrocket. They go exponential after 1971, after we were officially taken off the gold standard. We would return back to a standard where you couldn't just print Bitcoin to make up that debt and to create inflation to manage it. And so it would be a good thing because it would keep inflation in check. And actually, ultimately, which is you could allow for natural deflation from creation of technology and advancement of technology, especially in a world where in the next 5 to 10 years, we could see AGI, artificial general intelligence, which would arguably be smarter than certainly me. And so, all of us. And so that would be something that would be incredibly deflationary, where the productivity per citizen would go up so much that we'd be allowed to benefit from that deflation, where things would cost less. We don't have to pay as much. We don't have to work as hard to have all this wealth around us. It would allow for that. And so that's why I think it's ultimately the most, it's the most humanitarian solution out there, in my mind, long term. But it's going to take a while to get there. So, but way off in the future, you could say, okay, if we're on a Bitcoin standard, it doesn't matter. There are no dollars. You're not thinking of it in terms of dollars. You're thinking of it as, okay, 0.01 Bitcoin will buy me that car, or 0.1 Bitcoin will buy me that house. That you're thinking in dollar terms instead. And this is the hard part for people to get out of, because we've been conditioned so deeply to think of everything in dollars or euros or whatever. But across the world, dollars. We quote M2 in dollars. I don't convert M2 to euros. I convert to dollars. And so even if it's coming out of Sweden or it's Japan or wherever it is, we're converting it to dollars because that's the way our minds work. But it's hard to think, and this is, it's hard to think of the system that's different than the system that you've grown up with and have been embedded in and still are entrenched in every single day. And so that's the challenge. The challenge is to think about that system, really just step back and think about the system. And I agree with you. That's what has to happen. We'll have to actually be on the Bitcoin standard. You can't be half in, half out. I could see us running parallel tracks here for a while, where Bitcoin is a very useful store of value. where you have investors, and this is where Michael Saylor starts talking about, you have investors they're not just thinking about Bitcoin as a separate asset class in their portfolios, as opposed to stocks or bonds or even real estate. They're thinking of it as a store of value that's better than long-term bonds. And when that happens, that's a complete game changer. When you have institutional investors now allocating to Bitcoin instead of long-term bonds, why would they do that? Well, they would do that because they've lost confidence in the system. They've lost confidence that they're going to be able to invest in this long-term treasury and get a high enough interest rate that it'll outpace that expansion of money supply or inflation. And so it'll give them a real return. And so once they start doing that, then that's a totally different game. And that's kind of the system that I see in the future. You take your US dollars, you put them on an exchange to go buy Bitcoin. Well, you need something to buy, unless you're buying the ETFs, which is a whole nother conversation. But if you're buying them in a crypto exchange, then you use that tether to hold your dollars or euros or whatever it is. And tethers, I was up in Congress a few months ago, and we were talking to different representatives from congressmen and senators, and educating them on Bitcoin and kind of the landscape. And they are well aware, that Tether is a very important player. They're one of the top 20 buyers of U.S. Treasuries right now. And so it's not like it's just going to go away. They need Tether to continue to be a buyer of Treasuries. And that's important. It's like a money market, a vehicle inside a crypto exchange. It's exactly what it is. So it's an important, definitely important for the system. And I don't see it as competing as much as enabling people to get into Bitcoin.
If institutional investors start viewing Bitcoin as a preferable asset to long-term bonds, the implications could be significant. Traditional bonds have been a staple for steady returns over time, but with inflation and low interest rates, they're less attractive. Lavish explains that if confidence in bonds and the dollar continues to fall, investors may turn to Bitcoin as a more stable store of value. Once investors lose faith in traditional assets, Bitcoin could begin to fulfill a role similar to gold in the past, with potential to become a major reserve asset. In this future, we might see investors taking US dollars to exchanges to buy Bitcoin, using it as a safe haven against inflation.
Thanks for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more insights on investment strategies and financial tips. Leave your questions and comments below. I'd love to hear from you. See you in the next video.